Okay, we're back with continuing on Chapter 16. We've got some interesting things to do in this section. First, we're going to do what we spoke about in class already a couple of times, and that is the dividends received deduction, which they love to abbreviate as DRD. And here we'll get a chance to see how it works in reality. It's very objective and it's very mathematical. There's not a whole lot of planning done here, as you recall. The key concept was this sentence right here. It's a deduction to mitigate more than two levels of tax. Again, the concept was, and we spent some time on this, but the concept is C corporations are double taxed. If one C corporation, C1, owns C2, then you wind up exponentially multiplying the numbers of tax levels that will be paid if each one remains doubly taxed on its earnings and the dividends it pays up ultimately through the chain. So to mitigate that, the dividends received deduction is a way of saying, okay, let's not bother with it. Depending on ownership, you get to reduce the tax on what would otherwise be the dividend, which creates the double taxation, and everything works out for the better. Of course, what would really be better is to just get rid of double taxation altogether. And there's been some talk about that. Every few years someone mentions that that's what they should do. And the way, of course, that it's talked about is that they should simply allow corporations that are currently C corporations to deduct dividends. Right now they're not deductible. That's the reason for the fact that we have this double taxation. But the proposal is deduct them. And if they were, then that would go away. In the meantime, this is what we got to live with, is this famous DRD. As I said, it's quite objective, quite mathematical, so let's just see it, and then we'll go through the steps on an example. If the ownership is less than 20%, the dividends received deduction is 70%. That means of dividends received, 70% of them are not taxable. Same concept. If you own 20% but less than 80% of the dividends received are not taxable. And then the ownership of 80% or more, 100% of dividends received. This is by a C corporation, not an individual, so don't mess this up. The dividends received deduction only applies to C corps only. There's a limitation. I'm going to forego that and just go to the example, and again indicate that this kind of example here, again very mathematical. The software packages that you'll use take care of it. Notice finally, before we go to the example, is this does create a favorable permanent book tax difference, because for GAAP, dividends will be income in many cases, or at least in some case, depending on what type of GAAP you're using. In some method, dividends are received, are recorded for GAAP in some manner on financial statements. But here you see there's a total exception for tax purposes. And when they say favorable, it means that on the books it's being recognized as income but not on the financial statement. I mean on the tax return. That's why it's favorable. So it's on the books and off the tax return. I just want to stop and mention that so it helps reinforce the concept of favorable book tax differences versus unfavorable. The favor is based on the favorable or not favorable is on the perspective of tax. Are you paying more tax? That's not favorable. If you're paying less tax, it's favorable. Here's an example. You can go through it. Taxable income before the dividends received deduction. These are the modifications that you see here to get to dividends received deduction modified taxable income. Here's the dividend income, and the dividends received is based on the percentage of ownership, as we saw before. Here it's 70%, so that tells us, well, actually, this is the non-taxable amount, 70%, which means in this case they own less than 20%. This is why we say that. Look at this bullet here, less than 20%. So since it's less than 20%, 70% of the dividends are not taxable. 70% of the dividends turns out to be $21,000. There's a limitation that the software does on how much the dividend received deduction can be in any one year. In the first case, scenario 1, the limitation does not apply. Why? Because let's see what the limitation was. Let's go back. I didn't look at it, but let's see what it is. Limitation, where are we? Let me tell you where we're at. Let's first make some room here so it's a little less messy. We're at this point here where it's discussing the limitation. It's limited to the lesser of the actual percentage, that's what this part is, the actual calculated amount, or dividends received modified taxable income, whatever that is, and here's what it is. It's the taxable income before the dividends received deduction, before any NOL, before the DPAD, that's the domestic productions activity deduction, and the capital loss carryback. If the full DRD extends or creates NOL, this limit does not apply. And let's see how it works with these examples. All right, so first example, the modified income is $53,000, and so therefore, let's see, 70% of this number, 53, is greater than 21,000 here. In fact, this is the number. 37.1 is 70% of line 4. So we don't have a problem here, and the total dividend received deduction is 21,000. In scenario B here, what happens is that the dividends received modified taxable income is lower than before, and 70% of this number is this number. So the result is that this is all you can take of the dividend received deduction. That's all you can take. Now, good question, which I don't know, and we'll put on as one of our first research homework problems is there any carryover of a dividend received deduction? I'd have to look it up myself, so that's a great way to get us all to learn together. I'll put that up on Canvas. Okay, tax liability. Take a look at the tax rates. Maybe I'll bring it in as an addition to this slide on our next go-around to see what it's talking about here. It's interesting to look at the marginal rates, so I will bring, I'll make that an addition to our next video, because we'll have one more at least, and we'll take a look at the way the rates work. In essence, the large companies wind up paying 34, 35%, and most of the time 35%. This is the problem, which I'll probably mention in class again, but this is the problem because 35% is the winner in terms of worldwide corporate taxation rate. It is the highest in the world. Another good research question, and I think it's deserving for us to know because it's current events, it's going to affect your career. So a second research question would be, who is number 2 and how much? So I'll have you do that. I'm going to guess that it's France, but I might be wrong. We'll see. That'll be and I think the difference is as much as the number 2 might even be down to 25 or 30%. It's a big difference, and then it exponentially goes down for there, meaning many countries are way lower than this 35%, and this is what's creating, when we get to our international tax chapter of this course, creating a lot of U.S. dollars of profit to be shipped off seas, so to speak. It's not literally the way it's done, but through various tax inversions, what would otherwise be taxable U.S. income is being taxed in other countries at these lower rates. So it's a big issue. Congress keeps talking about it. With the presidential election coming up, we're sure to hear a lot more about it. The next item is controlled groups. And we're not going to get too deep into the calculation of them, but I think it's important to see inside the text what these are defined as, and to understand the principle behind what a controlled group is. And this is basically it. Corporations tend to be in superstructures like this or like this, with one common group of shareholders down here. And the reason for this is the division of legal liability. Here's one division of a company making toys. This is selling the toys. This is the retail stores for the toys. And now by having separate entities for each one of these divisions, there's legal liability protection between all three, and even legal liability protection of the parent. And the same with this kind of concept here. Here's a building, let's say. That's a building, this is the ops. So this is the real estate. And this may be ops 2, and this is ops 3. Different divisions, all separated into different entities for legal liability protection. We spent some time talking about legal liability protection, so I think you got the idea of that's why these companies do this. Now, you might say, okay, well that's great, except for the fact that there are limitations that we've learned about. There's the 10% charitable limitation per corporation. There's the graduated rates of tax per corporation. There's the dividends received deduction. There is and various other NOL concerns, capital gains. And so what the tax law was saying is that with all these limitations per corporation, if you got clever, particularly with the graduated rates here, if you got clever and said, oh, well, let's break all these up like this, for example, in this picture, or this picture, each one of these corporations gets the benefit of the bracketed rates, similar to in Tax 1 where you saw parents giving money that would earn income to children to use the children's lower tax brackets. So just like the tax law outlawed that concept of spreading out income amongst family members in order to use the graduated rates and spread it out, getting more graduated rate usage in each child or family member, the same thing with corporations. They have this control group. If it's defined as a control group, what you have to do is you have to spread out the graduated rates over the entire control group. So you only get one bite at the apple. You can choose where it goes. You can choose if this corporation will use all the graduated rates and these guys zero, or you can split it up, but you only get one bite at the apple. The basic control groups are two flavors. There's a third one which is called combined. I'm going to concentrate just on the two most frequently encountered, is what's known as parent subsidiary, and that is this. This is the parent subsidiary concept. So we'll just say this is parent sub, and if you haven't figured it out, this is the parent, and these are the subsidiaries here, where the parent owns 100% of each one of these. The brother-sister combination is where, picture number 2, that's this one. And here the idea is that the number of shareholders that owns this group is generally 5 in number, with certain criteria having to be met, 5 shareholders, and with that in mind, that means that they control these corporations, and it becomes an issue of no longer does the tax law allow you to use the graduated rates, and other benefits that each corporation gets. You have to spread it all out like we discussed before. So take a look at the text on the definition of the parent subsidiary and the number of shareholders with brother, sister corporations. I may come back to that and go through a little bit more of an example. The slides don't get into too much detail here. What we will do is we'll try to go quickly through the rest of the slides in our next, and then we'll come back to some of the issues that I've left open. So see you in the next video.